Welcome to the stock play of the day. Today's stock is going to be SPY. We'll discuss should we pass or should we play. Hello, my name is Brian Overby. I am the Senior Options Analyst with Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist with Ally Invest. Today, we're going to start the conversation by looking at the markets. There's a lot of red across the board. It's not feeling too good out there. It's a risk-off mode day for sure. This is the third day in a row that we're seeing the S&P 500 in the red. So investors are getting a little nervous. What's driving it? The action today really is the escalation in the spread of the coronavirus outside of China. So investors are becoming fearful of what this means from an economic perspective globally. So we've got a lot of red here. Also, if you take a look at the 10-year yield at 1.36-ish, that's very close to its all-time low. So that's going to be one to watch today, too, to see where that closes for a future indication of where we're going to go tomorrow. Brian, also of note is that the VIX is above 20%. It's a huge jump this morning. We're looking at almost 23%. What do you make of that?
VIX, we're definitely seeing some nervousness as came in the market, and that's really what the VIX shows us. We talked about the last downturn in the VIX where we saw the markets actually they're getting close to that level right now that we just had a couple of weeks back at the beginning of February. And when that happened, the VIX just spiked up to about 17, 18%. Now we see it going north of 20. And to me, that is a danger zone. That is literally the fear index. When the VIX gets to those levels, the market is starting to get nervous. People are running to the market indexes to try to buy some protection for their portfolios. And when they do that, when they buy that protection, that's what drives up the VIX index. And that's why they have a tendency to call the VIX index the volatility index based on the S&P 500 index options. That's why when they do that, we see that big jump up in the in the actual VIX index right now above 23%.
Yeah, it's a wild move for sure. With that, let me just remind our viewers that we are going to take your questions at the end of the show here. So in another 15, 20 minutes or so, if you stick with us for the whole time, you can type in your question in the box to the right of you, and we'll be sure to go through it at the end of the show. We love to hear from you and to participate with you, especially on a day like today when we've got a lot of volatility in the market. All right.
Well, let's look at the chart here, Lindsey. We have the S&P 500 index, and there's actually a lot to talk about in this chart today. A lot of times we're just like, oh, we're still in the bullish trend to the upside. But if I look at the SPX right now, we see a couple of things in the chart. We have right now a 6-month chart that we're looking at. And if we zoom in on what's going on recently, we see the blue line here. Right here, it's highlighted on our chart at 3320 approximately. That line is the 20-day moving average. Then if we go over and we look at the red line, which is highlighted here at 3276 on the chart, that is the 50-day moving average. And when I look at these two averages, it's pretty big that we break through the 20, but that's not a significant event. But we've just blown through both of those averages, and we're now down below the 50-day moving average as of right now in the markets. And we're kind of going back towards that low that we recently established. And we're highlighting it here right around, if I put my crosshairs on it, 3207. That's where the more recent low was at. And if we get down below that, that's going to be, I think we'll see the VIX even jump a little bit higher if we start getting down to that range. And that's kind of a fearful point in the marketplace. And then I even have highlighted on the chart here, all the way down at 3043. That's the 200-day moving average. And we've been overextended for quite a while as far as the S&P 500 is concerned, especially relative to that 200-day moving average. So some nervousness definitely in the marketplace, and I'll send it back to you.
Yeah, no, there is some nervousness, but this is actually a good point to remind our viewers that moves like today, like what we are seeing today, well, over 900 points on the Dow sounds big. It's just over 3 percentage points, and we have seen many days like this in the past. To put it into perspective, over the last 10 years, so since 2020, or excuse me, since 2010, we're in 2020. Since 2010, on average, we have seen 7 days in any given year of a 2% or more move in the market. And last year in 2019, remember when we got a 29% return in the S&P 500? Well, last year, we saw 5 times that the market declined at least 2% or more. So this is normal operating course for business right now, what we're seeing in the S&P 500. Certainly, the levels that Brian just indicated are worth watching. Certainly, the situation with the coronavirus is serious, and we're still trying to understand the full impact from an economic perspective in China and as well as the rest of the world. And there will be implications for certain companies and earnings of those companies with exposure to the area for sure. But right now, we recommend that our customers do not panic at this point in time on a one-day move like this. To also put it in perspective, just a reminder, going from October 2nd to Friday of last week, we were up 16% in the S&P 500. So again, it's natural to have a pullback after a run like that when events like this do occur. What you're seeing today, along with what we've seen throughout the rest of this year so far, is that we're only 4% off of the all-time high from the S&P 500. With today's move, we're still trading at a pretty solid premium on a PE basis. We're trading at 18.7 times on a forward PE basis. That's well above the historical average of about 15.6 times. So the market is still looking rich. Also, though, despite that, the market still looks attractive when you think about a dividend yield of around 2%, when the 10-year today is trading near its all-time low of 1.366%. So we do think the market still offers an attractive alternative for investors right now. But that being said, there could be some volatility as we continue down the road and we assess the impact of the coronavirus. Notably, again, to kind of help assuage worries a little bit about that, the World Health Organization, the WHO, came out earlier today, and they said that they believe that the virus has peaked and plateaued in China, where the majority of the cases are, of the over 79,000 cases globally. The majority of those are in China. The majority of the deaths that have been reported are in China, and it looks like things are starting to slow there, according to the World Health Organization. Now, the expansion of the disease into Italy, into South Korea, and Iran that we heard of over the weekend is certainly of concern and something that we will continue to watch. Right now, we're still expecting S&P 500 earnings growth of 5.6%. That could come down, but it's natural for that number to come down as the year progresses. What we would say really to our investors at this point in time, watch the levels that Brian suggested. Be ready for a pullback that could last a little bit longer, given the fact that there's so much uncertainty around this situation, and it may become a bit of a dicey market to be involved in. As we receive more data out of China on the economic impact there, as we hear from more companies that operate in China and the Asia region, also multinational companies that operate here in the U.S. So just be ready and aware for that. But the good news is that we have seen in the past that when epidemics or pandemics like this do occur, it has a temporary impact on the market, on the economic impact on earnings, and we will see a rebound from here. We're gonna get a second reading on the Q4 GDP number for the U.S. here later in the week, and economists are expecting the reading to continue to stay at 2.1%. We're going to get a lot of information on the housing market here, which should do really well with interest rates that are decreasing this significantly. Last year, this time, the 30-year mortgage, Brian, it was over 4%. Today, we're looking at it under 2%. So that's definitely bodes well for the housing market and the consumer going forward. We'll get consumer confidence, and we're going to get personal income. But I think I've been talking for quite a while now, Brian. How should our viewers trade this? I know you've got a great option strategy that you're looking at. What do you think?
Well, definitely. Okay, so let's look at the option chains here inside the Ally Invest option trading platform. So if what the numbers that I mentioned, we blew through the 50-day moving average, we blew through the 20-day, obviously. Where the scary number would be the 200-day moving average. But right now, just because we've had the big downturn, it is Monday, and it's amazing how many big moves you have on a Monday that can kind of retrace themselves before the end of the week. So I'm going to say that we're neutral to bearish on the marketplace, and I'm going to try to come up with a strategy that's going to fit that outlook as far as the markets are concerned. We currently see that we're down over 3% right now. The SPY is the stock that we're going to look at today, and the SPY is just the S&P 500 index. It's an ETF. It's the most popular ETF that tracks the S&P 500 index. So we're just going to look at an overall market strategy today. And the first thing that I'd like to do is I'm going to go out to the expiration. We'll talk a little bit more about this going forward, but the expiration that I'm going to choose is the 13-day expiration. That is 18 days away. And I'll discuss a little bit more why I'm picking that time frame when we get into the profit and loss graph at the end of my section here on the strategy for this week. So the trade that we're going to look at, it's called a skip strike butterfly. And here we see it inside the options playbook. And here is a graph at expiration. I like butterflies. Butterflies are very inexpensive ways to get either bearish or bullish on the marketplace. So if I look at the skip strike butterfly, here's what we're doing. The market is somewhere down here as far as the profit and loss graph is concerned. So the market's below my strike prices at this point in time. A lot of times I look at this trade and I think of it as an alternative to just selling a call spread or a bear spread. In other words, I sell a call spread. That means that I want the market to stay where it's at or continue on down. That's the concept that's behind it. I bring in a net credit. I hope to capture as much of that net credit as I possibly can when I do that trade. Okay. So if I'm looking at this skip strike butterfly, what we're going to do is we're going to sell a call spread. Basically, we're selling a call spread to help pay for our butterfly. And what this does is if the market starts coming back as we approach expiration, and ideally we're wrong on our forecast in that the market doesn't just keep going down, I'm a little bit wrong on my forecast. If the market comes back and finishes somewhere close to my short strike, the middle of my butterfly, I'm okay. So I'm giving myself a little bit of protection to do this trade. And when butterflies are interesting is when we have elevated volatilities. Because if we look at the setup over here on the play, we're going to be buying one at strike A, but we're going to be selling two calls at strike B. And because of that, we like elevated volatility. It makes that butterfly, quote unquote, or skip strike butterfly here, it makes it a little bit cheaper when we have elevated volatilities. All right. So a lot of talk about it inside the playbook, but it's a fairly advanced trade today that we're talking about here on the stock play of the day. So let's look at it back in the option chains. And the first thing that I kind of like to look at whenever I'm doing something where I really don't want the market to go against me, because I'm going to have more risk in this trade overall than the net credit that I receive. So the risk reward profile here kind of hurts us a little bit, right? We're going to bring in a small credit, but we're going to have a little bit more risk. The risk is going to be about 2 points minus that credit. That's going to be the total risk of this trade. Okay, so can the market move as much to hurt us bad, right? How do we figure that out? We look at right here, we have the market at 322.68. So if I just look at the 322.50, the most at the money strike here, we're looking at $7 on the call side. This is the call chain. And we're looking at about $6.50 on the put side. So let's call it $14, right? So 14 plus 22, we're going to call that 36. That's going to help us pick out our strikes. If we bought the put and we bought the call at the most at the money strike, that will give us an indication, well, what's the marketplace and the VIX index and the volatility saying that the potential move could be in 18 days by that March 13th expiration date. So I look at that and I want to say, well, I want to get out beyond that range. If the market starts coming back and it starts working against me on this trade, all my risk is if it goes all the way out to the 1335 level. So if the market really starts going against me, that's where my risk is. It's really in the last 2 points here from 1333, from 333 to 335, because we're talking about the SPY, which is a tenth of the value of the S&P 500 index. All right. So here's the trade, and I'm going to show you in the profit and loss graph, and I think that will clear things up a little bit more. Our whole goal here is that we want to do this trade for a net credit to the account. We're hoping the market continues on down, all our options expire worthless, and we can make this net credit. So in this instance, we're going to be buying one of the 329 strike calls, selling two of the 331 strike calls, and then we're going to skip the 333 strike. That's a mouthful, the 333 strike. That would be a normal butterfly. And then we're going to buy the 335 strike. That makes that leg, that protection, a little bit cheaper, but it does add additional risk. In other words, we're embedding a call spread to help pay for our butterfly. Now we can, instead of paying a net debit for the butterfly, we're going to bring in a 44-cent net credit to the account. That's our maximum that we can make. If the market continues on down, that's the maximum we can make, is that 44 cents. The width between the spread here from 329 to 331, that's 2 points. That's also in play here because, as I said, we're selling a credit spread to help pay for the butterfly. That credit spread is 2 points wide, and that adds $200 worth of risk. So our total risk on this trade would be $2 minus 44 cents, or $1.46 on this trade. That's our maximum risk if the market makes the expected move and moves all the way against us really hard and we don't get out of that trade. That's where our risk is at. But the profit and loss graph explains it well, okay? This trade has a lot of different outlooks as far as the market is concerned. If you notice the dashed line here, that looks a lot like the graph in the options playbook. This is at expiration. But we've embedded that credit spread to help pay for this trade. Ultimately, we want the market to go down. The market is sitting right here at this level right now. If the market continues that way, we're going to make 44 cents on our trade. But if the market comes against us, we have something that's helping us out here in this skip strike butterfly, in that the market starts going against us from the 329 strike to the 331 strike. We're actually long a call spread there. And so to start with, we have risk if the market moves against us. But as expiration approaches, that risk gets muted because of the way that we approach the trade. So for example, if I move the days to expiration very close to the actual expiration date, this will be with 1 day of time left. Now we see that if the market moves and starts going towards our short strike, that we actually benefit on this trade. And we could actually end up making $2, which is the width from of the spread from 329 to 331. So overall, let's summarize this, and let's get to your questions. And make sure you put your questions, if you have any for the show, in the box, and we'll try to address them at the end of the show. But here's what we're looking at. Normally, I would look at this type of trade with the increased implied volatility and just say, let's sell a call spread. Let's try to bring in a net credit. Volatilities are inflated. We're getting paid well for selling that call spread. This is an alternative to that. It's another step. We're going to sell a call spread, but we're going to also embed a butterfly inside of it. If we do that, that gives us some protection if we're wrong on our forecast. If the market doesn't stay where it's at or go lower, then this type of trade helps us out. It gives us a way to say it. It lets us, we don't want the cheese anymore, just let us out of the trap. That's kind of the way I look at this trade. If I'm wrong on my forecast and expiration is approaching, I can actually do better than my initial net credit to the account by doing this skip strike butterfly. All right, so let's look at the trade one final time. So it's a skip strike butterfly. The market right now is it's down over 3% still. Last price in the SPY was 322.86. We're going to go out and buy the 335 strike. We're going to sell 2 of the 331 strikes and skip the, and then we're going to buy 1 of the 329 strikes. This is the same expiration. All of them are March 13th expiration, and they're 18 days away. We currently see that trading for a net credit of 45 cents to the account. That's where I would try to work this trade. In the SPY, they have very good markets overall, but a midpoint fill is never guaranteed. And as always, when we're talking about the stock play of the day, we're just looking to do this to learn. It's not meant to be a recommendation. And especially when you're talking about an advanced trade like this, it's very interesting to look at how it reacts on paper. So our paper trade for this week is going to be the skip strike butterfly in the March 13th expiration of the SPY. All right, let's get to your questions. Let's see what we have here. So, first question. 1 second. We're going to eventually get there to your questions. Keep typing away, though. We got plenty of time. We can address a lot of them here. All right. Marcy from PA. Is this a start of the bear market? Back to you, Lindsay. I guess that's yours.
I'll take that one, Brian. Thanks. It's hard to say. You never know when a bear market is going to begin. Of course, when you're operating on a day like today, it doesn't feel good. But again, like I said in my review of the market action today, this type of move is actually normal for markets to have in any given year. So I wouldn't get too nervous yet, but I would definitely pay attention to where the market's going, where the data comes out. I think what we are definitely expecting over the course of the next month or so is to see some weaker economic data, some weaker guidance outlooks from corporations that have exposure to areas where the coronavirus has impacted business significantly, and that could continue to drive this risk-on environment, at least in the near term. So definitely, hopefully, this is a point in time for investors to remember to look at what their asset allocation is, and if they're sticking to that. So, Brian, did you say you had another question?
We do, and I was actually going to highlight my screen here. I didn't mean to interrupt you, but we have a great question. Jim from Beaver, PA. Is the option strategy similar to the broken wing butterfly? So that's actually the more common name, and I'm highlighting the actual options playbook. This is optionsplaybook.com, the book that I authored, but this is the companion website. And you'll see that we actually have an AKA here, which is broken wing butterfly, and also known as a split strike butterfly. I like skip strike because it's legitly skipping a strike when you're looking at a butterfly. I talked about that one strike price that we're skipping, which embeds the actual short call spread. So here, I just wanted to highlight that the AKA is actually broken wing, and that actually a lot of people will reference it more as a broken butterfly, but I don't think it describes the strategy as well. All right, well, that's it. No more questions here? Well, then let's get back to the summary. All right, Lindsay, let's look at the index.
The index, we're having a rough day. I think the reason that we're starting to, now that we're at the end of the show, the market's down a bit more. The Dow crossed the down 1,000 mark as we were speaking. I think a lot of that downside has been driven by the fact that the 10-year yield did cross. When I said at the start of the show, the record low for the 10-year yield was 1.366%. We crossed that. I think that also increased fears for investors, and the selling continued to strengthen. So now the Dow is down about 950 points from what my vantage point is. I just think this is a time for investors to stay calm but reassess your investment plan and your outlook, because this is a good time to make sure you're positioned the way you want to be positioned for the longer term.
All right. And so normally we would talk about our stock, but our stock is just the SPY, which is the ETF that tracks the S&P 500 index. So I'll just jump right into the option strategy. So my outlook here is we're neutral to bearish on the marketplace. In my scenario, the scenario that would make me feel the most comfortable is if the market either stayed where it's at or continued lower. If it just kind of hung out where it's at, we'd also see the VIX index, the volatility index, probably level out a little bit and get back down below that 20% level. And if that happens, that actually helps out our trade. When the implied volatility gets juiced up like this, butterflies become cheap. And when implied volatility comes down, they actually go down in price. So we're looking at more of a volatility play. We're neutral to bearish on the marketplace. It's just a very interesting alternative to just selling a call spread outright. All right, that's going to be it for the stock play of the day. Please make sure that you click subscribe and you ring the bell to make sure that you get all the alerts for all the stock plays of the day. And we'll see you same time, same place next week.
See you next week.